Welcome to another video in which we're going to look at writing off of receivables. We have two methods, the direct method and the allowance method, and we'll see how each of these, how we take care of the receivables when we actually do the write-off. So in this exercise, we're told at the beginning of 2021, we have $26,000 in accounts receivable. Because we're a privately owned company, we've been using the direct write-off method to write off our receivables. However, at the end of 2021, we wish to obtain a loan at the bank, which requires the preparation of proper financial statements. This means that we will now have to use the allowance method. The following transactions occurred during 2021 and 2022. During 2021, we installed air conditioning systems for $190,000. During the same year, we collected $185,000 from receivables on account. Remember, we had that 26 plus this 190. Of that, we have collected 185. At the end of the year, we estimate the uncollectible account to be 15% of ending accounts receivable. In 2022, the customer's accounts totaling $8,000 is written off as uncollectible. We've been asked to use the allowance method to record each of these transactions. Then we have been asked to repeat the same exercise using the direct write-off method. And then calculate the difference in terms of what's going to be the impact on your net income number. So I'll do the direct write-off method first because that's what the company has been using. And let's see what it would be if they continue using the same. So to start with, the accounts receivable beginning balance is $26,000. That number, it is what it is, 26,000. So it'll actually be the same for both the methods. So there's nothing else that we need to worry about over here. In this method, in the direct write-off method, and it will be the same for the allowance method, we had sales for $190,000. My journal entry for that is accounts receivable debit, service revenue credit, $190,000. Let me go ahead and post that number over here. The accounts receivable is posted over here. Now, would the method be any different if I was using the allowance method? No, this is a transaction. Remember, the direct write-off method and the allowance method, those are only the adjusting entries we're concerned with, not for transactions. So the accounts receivable debit, service revenue credit, that stays the same in both the methods. Next is I collected $185,000. So during the year, I collected, so I'm just writing the last day of the year, I collected $185,000. Cash debit, accounts receivable credit, $185,000. So accounts receivable credit, $185,000. I put that on this side. That's going to be the exact same thing in this method. These are real transactions, so it's not going to change. Both the methods, they're going to look exactly the same, okay? The next year, $8,000 is written off as uncollectible. Now, if this is the direct write-off method, I don't do anything in 2021 because I didn't get any information that anything is bad. I just will say, let me look at my balance over here, add up the two sides, and I've said $31,000 is owed to me, and I'll leave it at that. The next year, when I find out that $8,000 is not going to be collected, I write it off. At this point of time, I will say bad debt expense debit, and then I take my accounts receivable off my books. Only when I got information that I'm not going to collect the money. I guess the customer has filed for bankruptcy and I got a notice saying that I'm not going to get anything. At that point of time, I do bad debt expense debit, accounts receivable credit, and I take the hit over here. Now that's the direct write-off method. The impact of that write-off happens in the period in which I actually write it off in the future. And we'll see what I mean by impact of the write-off in a minute. The allowance method, which is the method now we want to use, the first two journal entries, those are transactions, so they're the same in both the methods. Now, if I was using the allowance method, at the end of 2021, I estimate that I will not collect 15% of ending receivables. So I will do the same thing as I did before. I calculate what my ending receivables are. It's $31,000. And now I'm saying of this 31,000, I am not confident of 15%. So I will do a journal entry. This is the adjusting journal entry that I will do. I will write bad debt expense debit, allowance for doubtful account credit, and that number is, it's going to be 15% of this ending number. I've said I want to have in this account 15% of 31,000, and that's a number 4650. And that's a number I'm going to plug into the journal entry. Now, since this is the first time I'm using the allowance method, I had no beginning balance over here. Now, in the next year, when I do the write-off of receivables, my journal entry is going to be, I have to take the receivable off my books. I'm writing it off, that $8,000. I don't debit bad debt expense because I already planned for it over here. What I will debit is allowance for doubtful account. Now, I know this number doesn't seem sufficient, but that is taken care of subsequently during the year. But the point over here is the timing of recognition of that bad debt expense. Remember, expense is an income statement item. The effect is it lowers my net income. So in part 3, they asked, what's the difference in net income before taxes, obviously, in the two methods? In this first method, the direct write-off method, it is in 2022 that I will take the bad debt expense. I take the hit to the to my net income number, and the amount is $8,000. In this method, in 2021, I planned for it, and I took a hit of $4,650. The remaining difference, whatever it works out to, will happen in the following year. In 2022, at the end of the year, I'll do the adjustment to cover what has not been covered over here. Again, the point is, in the direct write-off method, my net income number is not going to get affected with a write-off until I actually write it off in whatever future period that may be. In the allowance method, every year at the end of the year, I make adjustments and I take a hit to my net income number. That's the difference between the two methods.